Okay, let's unpack this. Welcome back to the deep dive. You've handed us the weekly market master brief for, well, a really pivotal 5 days, December 8th through the 12th.
It really was.
And our mission today is to figure out what happened in a week where, volatility really tried to take over. And the big question is, was that dip we saw a real chance to buy?
Or was it a trap?
Exactly. Was it a cleverly disguised trap?
It's a great question because the fear, it was palpable early in the week. We saw the Nifty actually surrender 26,000 for a bit.
A huge psychological level.
Huge.
Yeah.
And that should have set off alarm bells everywhere. But the key thing, the real insight here, is that the panic was so short-lived. If you look at the India VIX,
The fear gauge.
right, the market's fear gauge, it spiked like crazy. All the way up to 15.24 midweek. But by Friday's close, it had cooled right back down to a very calm 11.50.
Wow.
That snapback tells you the underlying conviction, wasn't really broken.
That rapid cooling is fascinating, but it brings us to the real puzzle here, the great divergence, as the brief calls it.
Look at the scorecard. The Nifty 50, the main index, it finished the week down 1.08%. Sounds bearish.
Sure.
But then you look at the Nifty Small Cap 100. That index finished the week green.
Up 1.2%. It's a complete disconnect.
It is. So what does that divergence tell you? You've got the heavyweights struggling, but the smaller stocks are just flying. Is this just pure resilience?
Or is it something else? Is it retail investors, the little guy, just aggressively buying every single dip and ignoring what the big institutions are doing?
I have to lean toward resilience. It feels like the domestic investor base is just deeper now.
Yeah.
They see value where foreigners see risk.
I see that argument, but here's the problem with it. If it was just pure, widespread dip buying, why did the bank Nifty underperform so badly?
Good point.
That's the engine of any rally, and it lagged the main index significantly. That tells me there is real targeted weakness in the financials, deliberate pressure.
And that pressure brings us right to the money war. This was a massive institutional fight. You have to look at the numbers to really get the scale of it. It was staggering. The FIIs, the foreign institutional investors, were just relentless sellers.
Every single day.
Every day. It was clearly a global de-risking move. They sold a net of approximately 12,500 crores.
12,500 crores.
In 1 week.
Yeah.
That's a massive statement from the global community.
It's a huge vacuum of liquidity, but here's where it gets amazing and why the market didn't just collapse. The DIIs.
The domestic institutions.
Our mutual funds, our insurance companies, they were the saviors. They didn't just step in, they were a shield. They net bought around 14,000 crores.
That kind of absorption is what prevented a crash, no question. They basically mopped up every single rupee the foreigners were dumping.
And then some.
And then some. But the brief really emphasizes the nature of the FII selling. They weren't just selling anything.
Right, they were targeting the heart of the index.
Exactly, hitting the most liquid names, especially the big private banks like HDFC and ICICI, places they can get out of fast.
Which explains why the bank Nifty got hit so hard.
It does, and it leaves you, the listener, with a really crucial question. When you see foreign money leaving like that, and domestic money rushing in with such force, whose conviction do you trust? And, can the DIIs really keep this up forever?
That is the sustainability question. And while we ponder that, we have to look at the global picture. The Fed.
Right. Segment 2, the Fed's dovish trap.
So the Fed cut rates by 25 basis points. That was completely baked in. No real surprise.
Muted reaction, yeah.
But the real story wasn't the cut. It was Jerome Powell's commentary. It was dangerously dovish.
And this is where the trap idea comes in. Powell hinted, he just suggested, that another cut could happen in early 2026.
If inflation behaves.
Right, a big if. But the market, it hears that and it immediately starts pricing it in today.
And that's a clear signal for more liquidity down the road. It calmed everything down. We saw the U.S. 10-year Treasury yield cool right off to 4.12% by Friday.
Which is great for tech stocks, great for risk assets globally. But here's the skeptical take. If the market is now betting the house on another cut that was just a maybe.
They're setting themselves up for disappointment.
A massive disappointment. If U.S. inflation ticks up or the economy stays strong, the volatility from that would be brutal. That's the trap.
And it doesn't help that the geopolitical situation is still, fragile.
Not at all. We saw those China-Japan tensions flare up midweek. That stuff keeps a lid on Asian markets, which in turn holds the Nifty back from any big rally.
But, okay, let's talk about the unsung hero for India this week, the silent dividend.
Brent Crude.
Yes, it crashed. crashed hard to a one-year low, settling at $61.50.
This is such a massive macro tailwind for us. For a net oil importer like India, I mean, this is as good as gold.
Our import bill shrinks. Inflation cools.
And it gives the RBI so much room to stay focused on growth. Honestly, this crude crash is maybe the single most bullish signal we got all week.
I'd agree with that. And meanwhile, gold just held steady around $2,410. Did its job as a safe haven when things got choppy.
So let's bring it all down to the ground level. How did all these big macro and money flow shifts actually play out in individual stocks?
A perfect tale of two cities. We have to start with the winner, the big structural story, Tata Electronics. The proxy stocks in the group, Tata Power, Tata Elxsi, Tata Motors, all rallied hard.
And the reason is just immense. Reports confirm that Intel is set to be the first major client for Tata's huge new semiconductor plant in Dhalara.
This is so much bigger than a weekly trade. This is a structural re-rating for India. We're moving from assembling things to actually fabricating advanced chips.
It validates the whole chip war ambition. It makes the Tata cluster a generational investment theme, regardless of what the Nifty does next week.
A narrative that really sticks.
And speaking of validation, we should briefly mention Keynes Technology, the comeback kid.
Right. After getting hit by those accounting doubts, management clarified everything, and then JP Morgan slapped a strong buy on it.
Calling it Asia's cheapest tech play. That triggered a massive 15% rally from the lows. Shows you how fast sentiment can turn.
Okay, now for the opposite, the operational disaster.
Interglobe Aviation, IndiGo. The stock got hammered, down about 9%.
And this was a self-inflicted wound, wasn't it? Pilot rostering issues.
A complete catastrophe. They canceled over 1,000 flights in just a few days.
1,000.
And the financial hit is just immediate and brutal. An estimated outflow of 610 crore in refunds in 4 days.
Wow.
The analyst view is unanimous on this. Avoid catching this felling knife. The brand damage is bad, the cash outflow is severe, and operations won't be normal for at least 2 more weeks.
It's the perfect example of how operational risk can just destroy any macro tailwind. Doesn't matter how cheap oil is if your planes are on the ground.
Exactly. So let's tie this all together and look at the week ahead.
On the positive side, domestically, the policy momentum is good. After the RBI signals, we have banks like SBI and HDFC hinting at lower lending rates from January 1st.
Which is a great signal for realty and autos. Huge tailwind.
But
caution on IT. That U.S. trade delegation visit ended with a very non-committal wait-and-watch stance. So for giants like Infosys and TCS, the momentum just isn't there.
Okay, so give us the technicals. What is the line in the sand for the week of December 15th?
Okay, right now the trend is neutral to slightly bearish. The FII selling still looms large. We have 2 critical levels everyone's watching.
What's the ceiling we need to break?
The resistance is at 26,200. The Nifty has to get a decisive close above that level to really say the correction is over.
And the floor, the point where things could get ugly again.
That's the support. To 25,800. This is the big one, the line in the sand. If that breaks on decent volume,
Then what?
then the odds of a quick slide down to 25,500 get very, very high. You have to watch that level like a hawk.
And what other risks are on the radar for next week?
2 things. First, the IPO rush. We have a few big ones coming up. That can suck liquidity out of the secondary market temporarily, a technical headwind.
Paying globally.
U.S. retail sales data on Tuesday. That will tell us if the U.S. economy is really slowing down, which would support the Fed, or if it's still too hot, which would scare the market.
So, bringing it all home, what's the final verdict? A dip to buy or a trap?
The consensus from the brief is pretty balanced. The panic is over, but the party hasn't started. Expect consolidation between that 25,800 support and 26,200 resistance.
So my takeaway is use the dips to buy resilience. Focus on those small caps and the Tata Group's structural story.
And my final warning is stay away from aviation for now and be very cautious with private banks until that FII selling really eases off.
Which brings us to our final provocative thought for you to think about. We know the FII selling was relentless, and the brief says if that selling drops below 1,000 cores a day, we should expect a sharp rally to 26,500.
So the real question isn't about the DIIs anymore. The question is, what is the fundamental change in U.S. inflation, in the dollar, in geopolitics, that will finally convince foreign institutions to stop de-risking and come back to India in a big way?
That's the true signal to watch for next week.
Absolutely.
Food for thought. We'll see you next time for the next deep dive.